Imagine waking up to a financial storm brewing across the globe, where the very foundations of banking seem shaky once again. Could this be the start of another crisis, or just a temporary scare? That's the unsettling reality hitting investors as global bank stocks tumbled on Friday, triggered by mounting worries over credit risks in the U.S. Let's dive deeper into this unfolding drama. And trust me, you'll want to stick around because the twists in this story are just beginning to reveal themselves. Picture this: a bustling trader on the floor of the New York Stock Exchange in 2025, hustling through the chaos. It's a scene captured by Reuters photographer Gina Moon, showing the human side of the market's volatility. This image isn't just eye-catching. It symbolizes the constant pulse of Wall Street, where one bad news cycle can send ripples worldwide. Key highlights: Zions and Western Alliance revelations spark panic. Fresh disclosures from these U.S. banks have ignited fears about hidden vulnerabilities. Echoes of 2023 turmoil. These recent events draw stark parallels to the banking crisis triggered by Silicon Valley Bank's collapse. Sky-high valuations and jittery investors. With markets already inflated, any sign of trouble amplifies anxiety. Reporting from Singapore and London on October 17th. Reuters highlighted how a plunge in U.S. regional banking shares amplified doubts about overall credit health and escalating dangers in the financial world. The sector's ties to two recent U.S. auto industry bankruptcies have revived memories of lax lending practices, issues that surfaced over 2 years ago during Silicon Valley Bank's downfall, when soaring interest rates led to massive unrealized losses on its bond holdings, causing a worldwide sell-off in bank equities. Now, investors are scrambling to gauge if these latest U.S. credit market hiccups could unleash a similar domino effect. An overnight Wall Street sell-off quickly spread to Asia and Europe, casting a harsh light on the explosive AI-driven rally in broader stock markets. Some experts worry this surge might have inflated a speculative bubble, ripe for bursting. But here's where it gets controversial. Is this AI boom a genuine game changer for growth, or merely a hype-driven illusion that could lead to painful corrections? We'll explore that tension as we go. European and Asian markets feel the pinch. European banking stocks SX7P nosedive nearly 3%, with Deutsche Bank, DBKGN.de, and Barclays, Bark.L, plummeting about 6%, and Societe Generale, SOGNPA, dropping 4.6%. This followed sharp declines in Asian financial firms, particularly Japanese banks, IBNKST, and insurers, IINSUT. In pre-market U.S. trading, the SPDR SP Regional Banking ETF, KRE.P, fell 2.4%, following a 6% drop the previous day, the largest single-day loss in 6 months. Zions Bancorp, ZION, under intense scrutiny, saw its shares slip 1.7%, with major banks experiencing comparable declines. U.S. stock futures also retreated, and in a sign of potential wider fallout, big tech giants like NVIDIA, NVDA.O, dropped more than 3%, underscoring fears of contagion beyond just banking. The catalyst? Zions announced a $50 million write-down on 2 commercial and industrial loans from its California operations. Meanwhile, Western Alliance, WAL, revealed it had filed a lawsuit against Cantor Group V, LLC, accusing them of fraud, claims that Cantor's lawyers swiftly denied. These announcements might seem routine on their own, but they arrived hot on the heels of the failures of U.S. companies First Brands and Tricolor. These collapses have shaken investors. High credit problems in private debt are on the rise, with default rates climbing to 5.5% in the latest second quarter data, according to Mark Dowding, Chief Investment Officer at RBC BlueBay Asset Management. He added that these defaults often come with weakened covenants, those protective agreements in loan terms, and fewer investor safeguards, potentially leading to bigger losses than in the past. For beginners, imagine covenants as the fine print in a contract that protects lenders. When they're watered down, it's like removing safety nets from a high-wire act. Adding to the alarm, JP Morgan Chase CEO Jamie Dimon recently warned about credit markets. When you see one cockroach, there are probably more, and so everyone should be forewarned. It's a vivid metaphor. Spotting one pest suggests a larger infestation lurking. Wider market ramifications. And this is the part most people miss. History repeating itself. Vasu Menon, Managing Director of Investment Strategy at OCBC Bank in Singapore, pointed out that the 2023 regional bank issues triggered a global bank stock plunge and broader market drops. Investors are haunted by those memories. Major U.S. banks have posted robust earnings lately, but with equity valuations at lofty highs, nerves are frayed. European bank shares, SX7P, have surged 40% year-to-date, while global stocks, MIWD 0000PUS, are up 16%, fueled by AI winners. Skepticism is growing that this rally has overstretched, with frequent sharp swings and safe haven asset spikes. Late last week's selling was exacerbated by rising U.S.-China trade tensions. Now, markets are fully expecting a U.S. interest rate cut in October, pushing government bond yields down and boosting safe haven currencies like the Swiss franc. Gold, meanwhile, hit a new all-time high, poised for its strongest week in over 17 years. Here's the controversy. Are these rate cuts a smart move to stimulate the economy, or could they just fuel more bubbles by keeping borrowing too cheap? Some argue it's a necessary evil to prevent recessions, while others fear it's enabling reckless speculation. What do you think? Should central banks lean harder on rates to pop potential bubbles, or is that too risky? Reporting by Ankur Banerjee in Singapore and Alan John in London, with contributions from Kevin Buckland in Tokyo, Stella Q in Sydney, Dara Ranasinghe in London, and Meta Singh in Bengaluru. Edited by Mark Heinrich and Mark Potter. Our standards. The Thomson Reuters Trust Principles. What are your thoughts? Do you see this as the beginning of a bigger banking crisis, or just market noise? Is the AI rally sustainable or destined to burst? Share your opinions in the comments below. Let's debate the future of finance.